Hello, I'm Brian Redican and welcome to TCorp's Investor Update following the release of New South Wales 26-27 budget. So at this session, we'll be running through what's driven the budget outcomes and how TCorp plans to approach the financing task there. But maybe before we get into the details, we could think about the economic context in which the budget has been brought down. So Emily, what is that economic context?
Sure. So if I think about the past year and what's happened, I'd say the second half of last year was actually quite positive. We saw strong growth in the New South Wales economy. Consumer spending looked like it was picking up and the housing market was quite solid. But if we turn to 2026, the first half of this year has actually been quite challenging. There have been a few shocks which nobody, including the government, expected at the time of their mid-year update. So the first big shock has been higher interest rates. So 6 months ago, most people were expecting the Reserve Bank of Australia to still be cutting interest rates now, but instead we've seen 3 rate rises and there could be more. And that's because inflationary pressures in the Australian economy were picking up, and the RBA felt that they had to raise rates to combat that. So that's been a big headwind to New South Wales and Australia more generally. And the second shock has been the Gulf War. And that has really added to the inflationary pressures around the world. It's added to the cost of energy and the cost of many other critical inputs. And that's affected the New South Wales government and many businesses in Australia as well. And finally, the third shock, I'd say, has been the federal government's budget and the announced tax changes that they've implemented on housing, particularly investment housing. And the impact of that is quite uncertain. But even before the budget, we saw the housing market in New South Wales and Australia more broadly start to weaken because of the higher interest rates. And the federal government's changes just make the outlook for housing even more uncertain. And really, overall, those 3 shocks have made inflation stay higher for longer, and it's really exacerbated cost of living pressures for households in the Australian economy. And I think we've seen that affect the budget and the measures taken there.
So we've had 3 adverse shocks. It has led to a larger budget deficit for 26-27 of $2.3 billion. How does the budget actually deal with those kind of negative adverse shocks?
So at a high level, the New South Wales government has to think about, what does the economy look like for the next few years? And really, we've seen the government expect higher inflation in the New South Wales economy for the next 2 years, but also much weaker growth. And that's a result of all those shocks and factors I mentioned. And that really feeds through to kind of the budget more broadly. So if we take a look at what the New South Wales government is forecasting for economic growth in New South Wales, there have been quite substantial downward revisions in the next 2 years. So as you can see in the chart, New South Wales is only expected to grow by 1% in each of the next 2 years. And that's a substantial downward revision to what was expected at the time of the half-year review. And that's mainly because of higher interest rates weighing on consumer spending, but also dwelling construction and other interest rate-sensitive parts of the economy. And you can also see that New South Wales's forecasts for growth are much weaker than what some of the other states are expecting their economies to grow by over the next 2 years. So New South Wales has been, I'd say, a bit more conservative in that view, expecting weaker growth over the next couple of years. And I'd say that theme of conservatism is evident in the budget elsewhere, where the government has been a bit more conservative on the revenues it will earn over the next couple of years, but also more conservative on the expenses. So, for example, expecting a bit higher growth in things like employee expenses and other operating expenses than some of the other states have assumed.
So I guess with that uncertainty, you can kind of cross your fingers and hope that shock disappears, but it seems like this budget sort of deals with them in a bit more concern. Are there any specific areas of the economy that's really being impacted?
Yeah, I'd say the biggest area that's been impacted has been the housing market, and the revenue that the New South Wales government earns from property-related taxes, in particular land transfer or stamp duty, that's been very noticeably impacted. So that's the amount of money the government raises there really depends on how much property is bought and sold, and also the price of that. And with the housing market weakening, the government has put through some quite big downgrades to how much revenue it expects to earn from those housing-related transactions. So it's downgraded the revenue by about $9 billion over the next 4 years, which is quite a big impact on the budget. And again, if you have a look at this chart, so what this chart does is it looks at how much stamp duty revenue New South Wales, Victoria and Queensland are forecasting to receive, and they're all set to 100 in the 25-26 financial year. And the lines just show how that's expected to evolve over the next 4 years in each state. And you can see that New South Wales is expecting by far the largest drop in the revenue from those land transfers for the next year or so. And there's no kind of big bounce back up to compensate. So this is one of the areas where the government has been arguably more conservative than the other states as well, expecting a much bigger slowing in the revenue from those housing transactions.
So that's a really kind of grim outlook for stamp duty revenues in particular. More broadly, what's kind of driving the budget outcome itself?
Yeah, so I think if I look at the budget, for me, the big kind of story and the driver of the budget is really the high inflation backdrop. And I think we see that in a few areas. So, we've talked about the stamp duty in the housing market and how that's impacted. But if you look more broadly, it provides generally a tougher landscape for the budget. So when you have high inflation, that increases a broad range of expenses for the New South Wales government, just like it does for a business. So for the New South Wales government, employee expenses are around 45% of their operating expenses. And when inflation's high, wages growth tends to be higher. And we have seen that in recent years, and we've seen that recently with the industrial umpire awarding some large wage increases. And that's to compensate workers for the higher inflation so that their purchasing power doesn't erode. But that directly feeds into higher employee expenses for the government. In addition, we've seen, the Iran war increase the price of oil and energy, as well as a lot of other key inputs, things like plastics, which increase the cost of medical equipment. Higher fuel costs make transport more expensive to run. We've seen the cost of construction materials increase, and that affects government construction projects and infrastructure projects. So high inflation really elevates all the expenses and makes it more challenging. There is a bit of a natural offset with revenue. So higher inflation and higher wages mean that the government tends to earn more revenue from payroll taxes. And as wages are higher, it supports spending in the economy. So GST revenue, overall in Australia tends to rise. So there are some offsets, but I'd say on net, it does make it tougher because it does boost expenses more than the revenues. So that's the general backdrop. And I think we've also seen in the budget the government be quite cognizant of high inflation and the cost of living pressures on households in New South Wales over the past few years. And that's why we've seen the government introduce some cost of living measures. So, for example, freezing public transport fares for the next year, giving $100 discounts on motor vehicle registrations, and a few other things like that. They tend to have been sort of temporary cost of living support measures and quite targeted, and not sort of huge permanent expenses, which is also good to see in the budget.
Yeah, it's interesting because when you see both revenue and expenditure revised higher, there's a tendency to think that the government's been given all this additional money and then they've gone out to find ways to spend it. But actually, it could just be the insidious impact of higher inflation coming through.
Yeah. That's right. That's the way I'm looking at it.
Okay, so Dan, Head of Funding and Investor Relations, you have got a larger new borrowing task for the next 12 months before budget is forecast to go back into surplus the following year. So how do you plan to approach that?
Thanks, Brian. Well, look, TCorp's approach to funding our FY27 program will not look too dissimilar to FY26. Made a couple of changes in the way that we're communicating to the market about how we're going to discharge the program. We are maintaining our weight to issuance by public markets, and we will continue to target 50% syndications, 30% tenders, 20% by reverse inquiry. Where the changes have come this year is we've decided to move to scheduled tenders twice a month on the second and fourth Thursday. We're doing that as a result of our market liaison work, primarily with our panel banks, but also debt investors. And there seems to be a preference that the market likes regular scheduled supply. We've seen this done by Treasury Corporate Victoria in FY26 to a high degree of success. We think that's a positive direction for the market to take, and we're going to evolve our approach and employ the same strategy for FY27. It's not going to look dissimilar to what we executed in FY26. In FY26, 30% of our program was executed via public tenders. There were 14 of them, and they raised just over $8.5 billion in face value. So when you look at our FY27 task and factor in 30% of tenders, the numbers are remarkably similar. It's just what we're doing is rather than having our tenders on an ad hoc basis, we're going to actually schedule them. There may not be tenders every second and fourth Thursday, but the intention will be that they will come regularly, and periodically holidays, blackout periods, and maybe other supply events may see some tenders cancelled, but we will be operating to that rhythm. The second way we've pivoted our communication to the market for the FY27, we have a funding program that was given to us by the government of $23.1 billion, and TCorp expects to undertake pre-funding of FY28, but we're also facing a dynamic of larger refinancing towers rolling down our curve. So we expect that we will look to make a start on FY28's task in FY27, and that could come by just carrying pre-funding into FY28. It may also come from buying back FY28 maturities and retiring them. We believe that indicating to the market that we think that we will fund around $2.5 billion a month if you average it across the 12-month period is going to be a better and more accurate reflection of TCorp's footprint on the market. So we would really like the market to look at that $2.5 billion a month and really understand that just under $2 billion of that is what has been given to us by the New South Wales Treasury Fund. The rest of it is TCorp's own overlays to manage FY28's task and beyond, but also our refinancing.
Yeah, that refinancing task is really becoming more kind of dominant in terms of what you're doing there. But it does seem like a notable evolution of the way you're interacting with the market. What kind of benefits do you hope that you'll gain from undertaking this shift?
Yeah, I think people who are familiar, have been in the semi-market for a while, will understand that it's undergone a lot of change and a lot of changing drivers and changing dynamics over the past half dozen or so years. It's really a move by us to continue to evolve our approach in how we funded markets to with how market dynamics are changing. We like the idea of being very transparent in what we do. We see that there are benefits in being predictable in what we do. And it's really trying to pick up on those things and transparency and predictability. I mean, obviously, there is also a way to increase market standards. There's also a way to position TCorp in the best possible light to the global investor base. And we see these initiatives in supporting that drive.
Of course, offshore issuance has been a hot topic this year. And the New South Wales Treasury has made some announcements on that. What kind of considerations will dictate, how much, when, and maybe where you engage in that offshore issuance?
Yeah, that's right. There has been a lot of talk over the last month or so on TCorp and will we or will we not be active in foreign markets. The best way for us to represent to people about how we're thinking about foreign currency is you have a little bit of a checklist here. First of all, it's got to be in the best interest of our borrowing clients. That's really important. In fact, it's most important. It has to fit within our funding plan and the risk management parameters that we have set in place. It needs to be compelling and competitive from a pricing perspective, but it also has to stack up against other alternative funding sources we have. So the way that we're approaching foreign currency issuance will be through that lens. And to be honest, it's the same lens that we apply when we're funding in Aussie dollars. If the opportunity arises and we can meet that criteria, we may well look to avail ourselves of opportunities in foreign currency markets. But we do expect that in FY27, the bulk of the funding program is going to be completed in Aussie dollars, and it is going to be completed through the Aussie dollar benchmark bond program.
And just more generally on your funding strategy, do you have any preferences in terms of format or tenor of potential issuance?
Yeah, I think now that TCorp's a dominantly larger issuer in the market, we have a very well thought out and developed funding plan that's been in place for a number of years. We are mindful that we have an ability now to move up and down our curve. So we like to schedule our issuance using the maximum amount of points on our curve that we can. Also, being flexible with regards to the format we issue in, whether it's a generic fixed rate benchmark, a floating rate note, a labelled bond off the sustainability bond program. The funding plan has been devised by the team here at TCorp to take into account the full range of issuance options we have. And also be very cognizant that we are looking to move around in our program and not be seen to have a heavy footprint on the market as we execute that program.
Great, thank you. So we did actually reach out to some of our investors for questions that they might have had about the budget through our dealer panel banks. So you might have some rapid fire questions, Dan, if you'd like.
Sure.
Okay, first one is, and you've already touched upon this to some extent, but does the $2.5 billion monthly pace imply $7 billion of pre-funding? And if so, what's driving the decision to pre-fund more?
Well, it's interesting. In FY26, people have seen on our funding announcement that we carried $4.3 billion of pre-funding into FY27 from FY26. You also look at the liabilities that we have maturing in FY27, you will notice that from a half-yearly review to the update we put out this week, term maturities in FY27 fell from $11.1 billion to about $9.8 billion. So it was actually a little more than the 4.3 that we did carry from FY26 into FY27. It's again, representative of the refinancing task that will be coming at us in the future, managing that as best we can, smoothing it out as best we can. And again, we're doing it in a way that we believe will limit our impact on market.
Okay. And how should investors think about reverse inquiry, and what's the best way to access bonds via that process?
Yeah, the reverse inquiry process is pretty well established here at TCorp and has been for a number of years. The approach that the panel banks make to us as it relates to reverse inquiry is unchanged, but when you think about our preference to discharge the program primarily through public markets, the bar for reverse inquiry is higher than it's been in the past. We do believe it is a very useful tool to have in the kit. We will use it in FY27. However, we will probably look at issuance through the lens of syndications and tenders first and reverse inquiry following that. But there are some instances that really suit the reverse inquiry method of issuing, and the early days of the Iran conflict is probably a good example of that. But also, as we think about how we might refinance our program, there is undoubtedly a role for reverse to play in that process as well.
So will you look to issue new second half maturities for 2030, 31 and 33?
2030, there is a green bond there, a November 2030 green bond. There is a chance that we may look to recategorise that as a benchmark bond. 2031 and 2033, there are a couple of floating rate notes there, and probably 2031 starting to get short on our curve to try and issue a new benchmark bond line and build it to the point that is a liquid bond. So probably less likely in 31. And again, in 2033, I think we'll probably take some close look at the floating rate note that is currently outstanding on that part of the curve, and look at ways that maybe we might be able to use that a little more as part of FY27 stars.
And a final, more general one. How are you seeing liquidity in your name and the sector overall? And have you noticed any trends over the past year? And do you expect them to continue?
Well, probably the most obvious trend that we're seeing in secondary markets is just the dollar value of turnover that is occurring in TCorp bonds. If you look from financial year 20 through to 2025, our secondary market turnover was growing at 15% per annum. It's really jumped up again in FY26. We believe on an annualized basis that FY26 may end somewhere around 310 to 320 billion. If that comes to fruition, that'll be more like a 60% increase on FY25's turnover. So there is a very, very big change that's going on in secondary market turnover, which is reflective, I think, of the Aussie dollar market is a lot bigger market now than it's been in the past. And obviously the semi-sector stands as its own subsector in its own right, and with a growing amount of bonds outstanding there is appealing to more and more foreign investors in particular, but just fixed income investors more broadly.
Okay, well, thanks very much for that. So we are trying to keep this as punchy as possible and not take up too much of your time. We have dealt with some investor questions, but if there are any more, I'm sure Dan is very happy to respond to them. But thanks very much for your time, and good trading ahead.